Hey, what's up, guys? John here. I'm going to walk you guys through a series of events that is happening right now. There are a number of billionaires, very, very successful private equity company founders, people across the board that are worth almost endless amounts of money. They're liquidating their stock portfolios in fashions that they've never done in the past. And a lot of these people are also reallocating funds into real estate and reallocating funds specifically into certain niches. And in this live stream, I'm going to walk you guys through what's going on and where I think this is headed. So this came out today. Obviously, everyone knows that Elon, they're saying that he's selling off so much stock essentially to cover a tax liability. Is that true? I'm not sure. I would think that that's probably not the truth, but I don't have any sign. I really don't have any data to really back that up. So far, he sold about 14 billion in Tesla stock. Before I begin, I'm just going to say what's up, everybody, in the chat. So he sold about 14 billion in Tesla stock, right? And so we look at also, Musk right now. He said that he took a vote on Twitter as to if he was really going to sell the stock or not. I personally, as I mentioned in a former live stream, I don't think that was. I think that he did that intentionally to paint a picture of him being fully transparent with the audience. But in reality, I think that the results of that poll are more likely biased, either through bots or something. I don't think that all of his Twitter followers, for the most part, would want to see him liquidate a large block of stock and then in turn hurt their potential holdings in Tesla. I will abide by the results of this poll, whichever way it goes, right? And so we look at people such as the, Bezos, Zuckerberg. They've sold a whopping $69 billion in stock this year, and total volume of sales from insiders up 30% from last year, roughly 80% more than the 10-year average. Then you have the CEO of Microsoft selling off over 50% of his holdings. And why I'm telling you guys this is because what I think is happening right now is all these people that I just mentioned could easily go get a loan against their portfolio for 1% or 1.5%. And they could then hold on to their stock and then use that liquidity to go purchase assets or whatever they wanted to do with the money. But they're not doing that. And I would personally think if they thought the economy was going to do that, they would do it because of what Biden and the Democrats had proposed, which is increasing the top marginal tax rate on individuals making over 400K per year to 39.6%, up from current 37%, while the White House also sought nearly double the capital gains rate for the highest earners from 20 to roughly 40%, making more. People making more than $1 million would have to also face federal rate up to 43% when existing Obamacare surtax on investment income is considered. Potential tax rates and code changes at the federal and state level are likely a motivator for some sellers, right? So they could really see a problem coming. I personally think that they know what's coming in 2022. And the reason that they're selling is because the market has been through an insane rally and they want to get out ahead and they want to be able to liquidate their portfolios before everyone else is aware of it. We're seeing the biggest names selling off their stock, right? And what I'm looking at is where are they reallocating their capital? Where are they putting their money? Because they, as I mentioned, they could easily get a 1% loan on their portfolio and hold both the stock and the asset in which they acquired through the capital in that loan, right? And then they could use that as a deduction and it would be a win-win for them, unless, of course, they thought the market was going to just take a complete dive. And then at that point in time, they'd be holding a loss on the loan against the stock, right? And so right now, private equity investors, this came out today. It's very interesting. So it came out today, private equity investors raise real estate money too fast to spend. Right now, what we're seeing, and I was listening to Steven Schwarzman, founder of Blackstone, saying that throughout the stimulus and throughout everything that's happened, that they've been raising so much money because people are looking to allocate money with people, with companies, corporations, and entities that have a grip on what's going on. And BlackRock, Blackstone, these corporations, these companies, they also know exactly what's happening, and they're investing accordingly. Private equity real estate investors raising money faster than they can spend it. U.S. funds have amassed a record $287 billion for commercial property deals, according to Preqin. That's up 11% from a year earlier and 57% more than at the end of 2019. The pileup of capital affirms the bet that real estate's rally will continue while inflation rises, stock wobble, and bond returns lag. And despite the new that could threaten a comeback for offices, hotels, and malls, U.S. property investment volume is expected to rise by 5 to 10% next year as firms try to spend down their dry powder, according to CBRE Group. Private equity giant Blackstone raised $33 billion for real estate deals in the first 3 quarters of this year while deploying only $25 billion. The challenge is that clients, pensions, endowments, high net worth individuals are hungry for more. Investors view on real estate as a safe place to be in an inflationary and low rate environment, right? What I think they're doing right now is they know that the dollar is going to fall without a doubt over the next couple of years. And even if asset prices are high in relation to the purchasing power in their currency, it makes more sense to pull out of their stock or to pull out in some of the riskier investments and reallocate the capital in real estate, because they can at least drive some revenue through the asset. And if you were to, look at it from like a replacement value standpoint, to rebuild the structures, everything is going up. So the cost to actually rebuild that property is going to follow. And people are seeing that. They're seeing it across the board. But what I'm looking at is going to be more of the differences in strategy. So right now, if you look at how U.S. funds held at record dry powder, right? You look at the growth in ever since everything that happened here in 2019, 2020, everything just started really snowballing for these PE companies, private equity companies. The volume of cash chasing deals helped drive up U.S. commercial property prices on average of 18% in the 12 months through November, led by a 22% jump in warehouses and other industrial real estate. Warehouses, mobile home parks, like what I think is going to be the big drivers going forward next couple of years in terms of real estate. Sure, multifamily is going to do okay, and residential is going to do okay, but I think the real big winners are going to be mobile home parks, because we're going to be in an affordability crisis where people are simply scraping by. And when people move into mobile home parks, they tend to stay for a longer period of time than as one would do in an apartment. And you're also buying a large block of land, and land, they're not making any more of it, right? And so they could always change building codes and zoning laws to where they could increase the density inside of cities. But if you're buying a big mobile home park, like what Sam Zell did, where he's the founder of Equity Residential, Equity Office. He's one of the largest landlords in the country. And what he did in 2009 when the market crashed is he allocated a lot of money to mobile home parks, and the investors, they found a 1,300% return on the back end of that investment. It's massive. It's almost like a crypto return. And what I think is going to happen is I think that warehouses, there's going to be a lot more online shopping happening over the next 6 months, a year, for sure, especially if we step into some problems where economy closes. So what will happen is that warehouses will become even more in demand, right? And industrial real estate, same with that. According to Real Capital Analytics, an expected surge of distressed deals has materialized, raising deployment of more than $91 billion in dry powder. Sales have already set an annual record with $614 billion booked in the first 11 months of 2021. Real Capital data show some of the increase stems from pandemic delayed deals that finally closed, but many sellers also moved to reap profits. GTIS Partners unloaded $1.6 billion of real estate this year and is routing capital to construct new single-family rental homes, apartments, and warehouses, which can generate higher returns than existing. This also, I think that they're doing this not just to generate higher returns, because building costs have increased and it's harder to find labor, right? So this is kind of what I'm seeing. So they're saying that they're going to get a higher return on building something new. Building costs are increasing. It's harder to find labor. And right now there are shortages across the board. So I don't see how the building costs would, their returns essentially would increase, whether they could buy something, let's say, that needed work, where they could do value add, do something to, extract some sweat equity in the deal. What I think they're doing is I think they understand what's going to be happening with this green movement. And so they can build properties and structures in a way that's going to be compliant for the future. And that's going to be long-term better for shareholders and the investors that are investing in those funds, because they're then going to be able to circumvent all of those potential problems that people that are holding older structures are going to be faced with. Jen Psaki at the White House is saying that they want to get rid of lead pipes. They're talking about decarbonizing these structures. They're talking about a lot of very, very big actions, expensive actions that'll be taken across traditional real estate structures. They're saying 40% of carbon comes from real estate. And so when they're building new, they're building out a solution to the problem that they know they're going to be facing, right? And they go on to say right here that our trade is to sell old and buy new, right? And that's exactly what I think the real reason is. I think they're trying to sell the old structures to get out from that potential problem. Because the more people become aware of what it's actually going to cost to make these buildings compliant, the less they're going to get for those structures, right? And then ultimately what's going to happen is they're going to be able to refi out their money after they build it out. They're probably going to obviously self-finance it or possibly get a loan against the assets in which they're going to build. But ultimately they're going to get fixed, long-term debt on these properties that, typical people and everyday individuals won't be able to get access to. But this is what I think they're doing. I think they're just really reverse engineering the problems that are in front of us. A New York-based real estate investor with $4.2 billion in assets, our focus is putting money to work versus raising money. While stepping up direct investment, private equity is also contributing to a record $4 trillion of debt outstanding for real estate, lending as much as $100 billion this year, according to the Mortgage Bankers Association. The private equity money is funding construction, remodeling, and other relatively short-term borrowing that's often too risky for banks, charging higher interest rates in exchange for more generous terms, such as greater LTV ratios and no prepayment penalties. We're getting paid to take risk, right? Paid to take risk. He expects to lend $10 billion, up from $7 billion in Q 2021. So far, it's been hard to make bets out of the risk spectrum. Accor announced a $1 billion fund for hotel rescue financing in February, but it's only deployed $200 million, right? And so what they're banking on right now is they're saying that they don't anticipate more deals unless this comes up, right? But we all know that's coming. Like, it's already in front of our faces. We look at the global news right now. This is all a threat, right? And so if this does happen in hotels and ever, like, really just tourism, real estate gets impacted by the travel restrictions and the restrictions, right? These companies are going to run out there and acquire these mom and pop hotels. And what I think is ultimately going to happen here is I think that they're either going to keep them as hotels or they're going to repurpose them as housing, long-term viable housing. They're just going to basically rezone it if they can, which they likely could. As the pandemic drags on and remote work becomes more acceptable, office buildings may be the next big target for investors seeking discounted properties. Current owners are reallocating money to other real estate sectors. Managing director of investment bank and brokerage, right? Several institutional investors are unwinding office. The big problem with office is that now we're starting to see that office is going to be stepping into a real big problem. I think a lot of companies are going to be forced to downsize their staff so they could have an office that was really needed for the amount of people they had. They might have to let go of 20% or 30% of their employees. They might have to relocate to a different state. Office is going to see higher vacancies. That I almost guarantee. Office is going to see higher vacancies, and at that point in time, we could see a resetting in office prices in certain cities. We pay attention to what's happening in Boston, Washington, New York, LA, Louisiana, Denver, all these places. They're going to be enforcing, which is going to really impact office real estate without a doubt. Blackstone targeting property types with higher demand than supply based on demographic and technological trends, life science labs instead of traditional offices, warehouses rather than malls, This week, the firm agreed to buy apartment landlord Blue Rock for $3.6 billion, right? And what I think is going to happen here too with malls, they're choosing warehouses rather than malls. Well, obviously malls are going to be dead. That's what I'm betting on. But I think malls ultimately end up getting repurposed. I think malls are going to get repurposed and they're going to find a higher use, most likely for e-com. They're going to find ways to extract more value from malls. If you walk into a mall now, it's basically dead. No one's really, except the holiday season, people of course are shopping. But if you look at what the malls were a couple months ago, I was in LA, malls are pretty dead. They're not generating the returns that they once were, that's for sure. So an investor or a group of investors is going to go out there and find a higher use. In an inflationary environment, if you own assets with pricing power, they should outperform. So that's what they're doing. I personally think that strategy, that I think it was GTIS, they are selling old and building new. I really think that is going to be very, very popular, because if we pay attention to what's happening right now in Ithaca, New York was saying that they're going to decarbonize the structure. It's going to cost about $50,000 per single family house. They were paying attention to what's happening in New York City, where they were saying that if structures are, if they have, like, each structure apparently is going to be allowed a certain level of carbon, right? And so if you are underneath of that threshold, you're going to be able to lease out your carbon credits to other property owners nearby, and they would have to pay a lease term for it. But if people are building new, they're going to be able to build it and build out an additional source of revenue through that structure. It sounds crazy, right? But this is what's happening. It's set. This is what the world's going to look like. I'm going to read through some of these comments, see what you guys think about this. Yeah, let's smash that like button. YouTube will share the content. More people that see it, the better. More people that really kind of awake to this. He just bought a home in Cali for $600K. Do you think it's worth the money? I guess it all depends on I think that people should be looking at things more along the lines of not based on dollars as much as we used to think about things. Because what I think is going to happen is, I think over the next 12 months or 24 months, we're going to start to see the dollar take a massive fall. That's what I think. I think we're going to be universal basic income programs that could potentially come out. I think there's definitely going to be more stimulus. You just heard Biden saying that he's extending student loans until I think May of 2022. More unemployment benefits. There's going to be a lot more stimulus and printing. And when that happens and costs rise, gasoline prices, JP Morgan was saying, going to go up to $150 a barrel in the next, I think, 12 to 18 months, which is almost a double from where it is now. Think about how much more expensive it's going to be to get food and products. When you think about the shortages and the problems that are potentially in front of us, right? So if you're looking at things from a dollar perspective today, I would think about really looking at it more from the eyes of a purchasing power, preserving your purchasing power and investing your money in a way to where you're going to be able to not just try to 10x or take a big risk, but preserving that purchasing power in a way to where you're going to grow as the dollar is falling. And so when you ask me a question like $600K in Cali, someone said $600K in Cali is a steal. It depends. It depends on where in Cali. I think that's probably the best way to look at it. Where in California? Now a house in Compton or Watts, or an area where a lot of people thought that area was undesirable, or there's a lot of crime, the house there is probably $600K, right? And so if you're looking at like LA as a whole, $600K is very underpriced, below the median. Median home price in LA right now is about $750K. So, but $600K though, if you are, let's say, out in the middle of nowhere in California, $600K could be extremely overvalued. So it all depends on your area. So I wouldn't want to just give a blanket answer that say, yes, $600K is good, $600K is not good. Someone said Bitcoin versus gold. Bitcoin versus gold. Bitcoin, this is what I think. I think that gold will preserve your purchasing power in the event that we step into a very high inflationary environment. Gold will preserve the purchasing power. Gold might maybe 1x, 2x, 5x, or 10x. Bitcoin could 50x, could 20x, or could drop by 50% or 80%. That's the thing with cryptocurrencies. There's a lot more volatility, but I think that the consumer, the investor that's buying gold, is in a different mind frame. It's not a 25-year-old or 30-year-old for the most part going out buying and storing gold. It's an older investor that's been around the block, and they're using that gold as a store of value, and that is it. Whereas a Bitcoin investor today, they're trying to preserve their money. They want to get their money outside of the banks, and they also want to, hold and be able to control their own wealth through cryptocurrencies, right? And they want to kind of stick it to the system. But there are two different types of consumers. But I do think that in the event of a recession or depression or a huge sell-off, I think the idea of having Bitcoin, I think it's very liquid. You can sell it in a minute, right? Or less. You can just hit the sell button and sold. Gold, if you're storing gold, it's not so easy, right? So I think in a depression or a recession or an internet outage or anything like that, you could see a situation where, at the end or in the middle of that, people are going to start looking to sell things if they have to, if they're in a desperate position. They're going to sell crypto. I think a lot of them will sell crypto before they sell their home or before they sell their car, right? And so I think there'll probably be more volatility, but with volatility comes opportunity to make money. So I would suggest that if you're going to invest in crypto, invest what you are, that you'd be comfortable losing or not. Like if you have, let's say, 50K in the bank, I wouldn't invest all 50 into Bitcoin. That's just me. I'm kind of risk adverse. I'd bet maybe 10 of it, but I wouldn't go 50. I wouldn't go the whole 100% in Bitcoin. But I'd probably also split it up between gold. I'd probably do a 50-50. I would hedge my bets. Smart money is they're buying real estate, but a lot of the smart money is also they're purchasing plots where they can build real estate, which I think is very smart because of the future zoning laws. Zoning laws are going to be nuts over the next year, 2 years. If you heard the Secretary of Energy, she came out and said that we are transitioning off of fossil fuels, right? We are transitioning off of fossil fuels. What does that mean for old structures? It means that it's going to be extremely expensive to transition off of fossil fuels. This isn't going to be an option. People are going to be forced to do this. And if you don't have the money and the liquidity to do it, that's going to really bring in a big opportunity for the private equity firms, the investors, just like in Ithaca, New York, where these private equity investors are essentially lending money on structures in the city, not by option, by force, on these assets, and then the owner of the asset has to pay a monthly, like monthly premium. It's a forced loan. Yep, it's pretty. It's interesting. It's interesting. It's definitely worth paying attention to what's happening here. That's why smart money, as a recap, if you're just joining, smart money right now, a lot of the stocks are being sold. A lot of investors are liquidating large blocks of stock. And, we look at who, I reported on this before. I'm not going to go through it again. Zuckerberg, Bezos, they sold 69 billion. Musk sold 14 billion recently. He's going to sell some more. This came out today, by the way. He's going to sell some more. They're saying that it's for a tax liability. I personally don't think so. But we look at why, really, if they were thinking that the market was going to remain the same or go up, they wouldn't sell. They'd take a loan out against the portfolio, right? But they have not decided to do that. Why? This could be a reason. I'm not sure, but they're saying that for the White House also sought nearly to double the capital gains rate from high earners from 20 to 40%. People making more than $1 million also have to face federal rate up to 43.4%. All these people would obviously fit that bill. But I personally think that they are selling because the market has just went through an insane rally. They want to take risk off the table, and they think that there's probably going to be a sell-off is what I'm betting. And so what they're going to do is they're going to take the money off the table, and then when there's blood in the streets, they're going to go out there and buy. That's what I think is going to happen. They also know that the US dollar is going to have a troubling 5 years ahead, and they don't want to be stuck holding the stock. That's what I'm betting on. That's what I'm betting on. But private equity, these big investors, they never get it wrong. And you know why? Because they have better information than what we have. And so I follow them. I follow them to see what they're doing. And I share that report with you guys so we can all make smart investments. And we are building out a plan that's in line, or at least in the same frame of mind as the smartest people in the room. I'll catch you guys on the next live stream. Hit the notification bell to join it, and see you guys later.